Welcome everybody, Mark Robinson here from the Wealth Game. Really excited to have one of our experts, Greg Watson from the Investor Hub. Now, those of you that know me, you've heard me say this a couple of times. Greg is by far one of the most experts in investment finance in Australia. And Greg, mate, thank you for taking some of your time, mate. I know you're a busy man to just give us an update on investor finance, a not so brave new world.
Yeah, thanks very much, Mark. It's an interesting time at the moment, and very happy to share those changes with everyone because there's a lot of stuff that people need to know about these days. There's a lot of things that have changed.
Yeah, mate. I mean, before we get into it, do you think? I honestly didn't think that the changes that they've made would be so fast and so broad, mate. Did you see this? I mean, I think you saw this coming, but did you expect it to come through so fast?
I think there was some expectation that there was going to be some changes because of the amount of noise that was being made from the regulatory perspective. But yes, we're surprised that it's happened so fast and that it's been quite so severe in some aspects. And obviously I'll go through those in a minute. But it's been amazing the amount of change there's been in such a short space of time. And yeah, I think it caught quite a lot of people on the hop. But a lot of the banks moved quickly to change their competitive position so they weren't missing out, I suppose. But anyway,
Yeah,
that's the way it is.
Cool, mate. Well, the floor is yours. Guys, I just want to remind you, if you've got any questions, please type them into the question box while you think of them. And every now and then I'll butt in and ask Greg your questions. Has everyone got that? Everyone's ready to go? We all ready to rock and roll? Discrimination against investors. Of course, that's it, Mike. Let's start off with that way. Greg, floor is yours, bud.
All right, thanks, Mark. So thanks for joining us, folks. Really appreciate you taking the time out at lunchtime to spend some time with us today to talk about investor finance, a not so brave new world. There's been a lot of changes in the investor scope over the last, the investor space over the last month to 6 weeks, and I want to run through some of that today. We'll look at the background to the changes, the regulatory reaction that there's been to some of those, then the bank's reactions to that, how banks are bastards, and some of that may come as no surprise, and look at some of the unintended consequences of the actions, then opportunities for homeowners and investors alike, but sort of separate, I suppose, and what comes next. So that's kind of a broad outline of what we're going to talk about. So the first thing I do have to go through is our usual disclaimers. So this is general advice only, and the information contained in this presentation is general in nature and does not take into account your personal situation. You should consider whether the information is appropriate to your needs, and where appropriate, seek specific professional advice from a mortgage or financial advisor. There might be some of those available right here, accountant or other professionals. Tax, financial, legal, and other matters referred to are of general nature only, and I'm sure you can read the rest. I'm an authorised representative of Bletzer Proprietary Limited, which is our aggregator, and a mortgage advisor accredited with the MFAA. So let's get down to business and actually what we came to talk about. And that's about what's been happening in credit markets over the last little while. So the background to change is, you can see the visual here. The auctioneer says yes, and Glenn Stevens says no. Glenn Stevens is the gentleman on the right. He is the chairman of the Reserve, or the governor of the Reserve Bank, and of course we've got a real estate auctioneer on the left. The background to what's been happening is that there's been some massive changes in the property market and a lot of growth. It's been widely documented. You've probably been under a rock if you've not heard anything about it. And if you were, you're probably not in this webinar. But the growth in Sydney and Melbourne has been particularly strong, and that's caused some concerns at government, Reserve Bank, and financial regulator level. That's not so much in most other areas, and certainly not a lot of regional areas has the growth been anywhere near the kind of strength that we've seen in the major capital cities of Sydney and Melbourne, which are the two major population centres of Australia. So that's caused some concern at a regulatory level. The government's been arcing on about it for quite some time, and a lot of commentators talk about this housing, so-called housing bubble. Interestingly, at the top of every housing cycle, their commentators start talking about housing bubbles. Anyway, we'll see what happens about that, but I'm really not going to go into whether it's a bubble or not, but I think you've already worked out what my opinion might be. But so the concern from the Reserve Bank's perspective is around monetary policy. So they've been implementing their monetary policy, reducing interest rates, trying to provide some stimulus to the economy. The federal government doesn't seem to want to participate with an overly stimulatory fiscal policy, because there's a political notion in Australia for some reason that we should have a balanced budget or we should be in surplus. From an economic analysis perspective, that actually doesn't work. And sometimes you need to have a stimulatory budget position and go into deficit, which is what we did during the GFC, which kept us out of trouble to some degree, and certainly kept Harvey Norman shareholders well up with their dividends, because a lot of those bonuses were, I used to call them Harvey Norman bonuses, but they were used for a lot of consumer goods and things like that. But anyway, I won't go on about my thoughts about where the government should actually be spending their money, but maybe some infrastructure might be a good idea. But the decrease in rates from the Reserve Bank normally would be a stimulatory effect on the economy, and in the absence of that happening from the federal budget side of things. But what we've actually seen is we've seen a decrease in mining investment, a very substantial decrease in mining investment, a falling exchange rate, which is kind of what you'd expect actually, and it's good that it's finally arrived. Probably not great if you want to travel overseas, but it's good from the stability of our economy. Inflation's low, but the offside of this, which they're probably not looking for, is that household spending has declined, business investment has declined, and unemployment has gone up. So whilst we've got a lower interest rate environment, we've got an environment where the exchange rates now are somewhere down around where its long-term equilibrium is. We've seen a rise in unemployment and a decrease in spending. So really, the interest rate and monetary policy has been quite ineffective. So in this low interest rate environment, we've seen investor lending rise substantially, and that's caused quite a lot of concern, because people are struggling to actually get into the housing market. But also in the low interest rate environment, partly driven by investment, we've seen home starts increase, which is usually how the economy turns around. So home starts increase, building and construction increases, more people are employed in those sectors. That flows through to the industrial sector, and the economy tends to pick up through that. But when I go through some of the unintended consequences, you'll see how these actions that the RBA, APRA have taken are actually going to be contrary to what's required there. So in reaction to that, APRA, other way, there we go. The regulator's reaction is around APRA, and APRA is the regulator of building societies, credit unions, banks, and insurers. So basically all deposit-taking and insurance institutions in Australia, the large ones. So APRA have gone into a mad state of panic, and their banking analysts are running for the hills, and their credit analysts are running for a latte. But who is APRA? They're the regulator of all of the deposit-taking institutions, including the banks. But who has a seat on the board? At the moment, there's only two people on the APRA board. One of them is an ex-RBA senior advisor, and there's another one. There's another vacancy at the moment. So it's very heavily influenced by what happens in Martin Place. So, APRA's reaction has been, in terms of how it's spoken to the banking industry, has been quite severe. They've had a bit of a knee-jerk reaction and increased capital requirements for some of the major banks. You might have seen some of them have done quite a bit of fundraising, capital raising over the last month, I suppose, but probably the last 3 weeks there's been some major capital raisings by the banks. So they've increased their capital requirements, and they've placed restrictions on credit growth in one specific segment, and that specific segment is investment lending. So they've decreed that there's now going to be a maximum 10% growth in investment in banks' investment portfolios. Their target is to have that 10% collectively, but they're also saying to banks individually that their growth can't increase by more than 10%. And there's been some other changes as well that they've specified for particular institutions on a one-off basis. That'd be the phone. One credit union that I've been doing some work with over a number of years has been actually told to stop lending totally in mortgage insurance territory, so they can't lend anything over 80% of the value of a property for the foreseeable future. And that's the reaction there, is basically in order to balance their portfolios back to where they want to see them. So obviously the banks have had to react to all that.
Greg, how do you think the banks are going to go with this capital raising? With most of their shares have been absolutely smashed, and are they going to have to reset? Because I've been getting a lot of obviously correspondence from them saying, hey, we're going to issue you some shares if you want to take them up. And they were about $2 less than what the market price was at the time. Now they're probably about anywhere from $5 to $8 more than what you can pick up the shares now. Yeah. How do you think they're going to deal with that?
I think they'll probably deal with it they'll probably get most of their funds at an institutional level as opposed to mum and dad investors, and they will have to negotiate with those institutions, hedge funds and super funds, and probably each other, because they generally have holdings in each other as well, which is interesting of itself. But I think that's probably the way that they'll end up getting that that equity over the line.
Yeah.
It'll have to be through negotiation with the major players in the equity raising market. I'm pretty sure that's how it's going to happen. But I think ANZ have already put theirs away, and interestingly, their share price fell 2% at open of trade this morning.
Yeah.
Excuse me. So there's been a lot of flux in that market, on the share market, over the last couple of weeks. And I guess there's been a lot of volatility in the share market, full stop. But bank shares have been particularly volatile, and they've been leading because they're so big as a proportion of the market. They tend to lead a lot of the movements in the market. The four big banks in VHP and Telstra, account for a very large proportion of our share market. And apart from Telstra, all of those have been moving around a fair bit over the last couple of weeks. Sorry, excuse me for a sec. Right, sorry, back again. So looking at those have been the regulators' reactions. The bank reactions have been varied. So you see that chart down on the bottom left-hand corner about housing credit growth. So that shows over towards 2014, that red line, which is the investor credit growth, has been creeping up towards 10%. That's jumped over that at the beginning of, the first 6 months of 2015. And that's what's triggered this reaction from the regulators, and thus the new requirements on the banks. So there's a number of different areas that I need to cover off here, including obviously credit growth, loan servicing, and interest rates. So I might just run through. There's half a dozen things here. So if you've got any questions on these, please put them in the chat box, and we'll address them at the end of this slide, because there's quite a lot of different areas, and it does vary from bank to bank. But I won't try to do every bank's policy, because obviously we've got 30 lenders. It'll take me a week. But anyway, we'll cover off first servicing margins. So what was the case in the past for a lot of organisations that were particularly keen on the investor segment? They would only take the actual repayments of a loan as being what was required for servicing. So if you had an interest-only loan on an interest-only loan of $500,000 at 5%, the repayments on that are $25,000 a year, or a bit over $2,000 a month. So they were taking that $2,000 a month as the actual repayment in terms of determining the servicing for your next loan. However, what practically all of the banks have done now is they've reverted to a principal and interest loan plus a margin for servicing. So where it used to be, let's say it was a 5% loan, we would look at the interest-only repayments on 5%. Now we're looking at the principal and interest repayments over the term of the loan on somewhere between 7.2 and 7.4%. So the banks have added that extra margin basically to ensure that people can afford a loan at full principal and interest levels once loans have gone up by 2.5% basically. It's an interesting that they've chosen to do that at this point in time. It's certainly going to be restrictive on people who are highly leveraged, but by having the buffer being so high, like the 7.25 or 7.4%, and some of them are slightly higher than that, some of them are slightly less, but it's thereabouts. They're actually moved themselves out of the next interest rate cycle, because the forward rates are showing us that we're only looking at increasing by around about 1.5% over the next interest rate cycle. Now, unless something structural changes in the meantime, they're requiring us to service at a principal and interest level on 1% above where the top of the next cycle is going to be. So anyway, that's my little bit of crystal ball gazing based on the futures markets. But so servicing has certainly been tightened. What that's actually meant that marginal loans are now no longer a deal, and people who would have been comfortably servicing a large amount of debt are now struggling to leverage, struggling to leverage up more and get more highly geared. The other thing that has, has been quite strong in the reaction has been loan to valuation ratio restrictions on investor lending. Some lenders, including some of the majors, have reduced their investor lending percentages to a maximum of 80%, and that includes the likes of Bank Western, CBA, and includes the likes of Westpac as well. The others have capped their investor lending at 90%, and are including mortgage insurance within that, so it's actually reducing it from 92 to 90. So there's been reductions across the board. Probably the most extreme reaction has been that of AMP Bank, who have basically drawn a line in the sand and said, from this point forward, we shall no longer be writing loans for investment properties. That's a pretty extreme view, and I've got a number of clients who've done investment loans with AMP. Obviously, the loans that are there are already there. They don't need to be refinanced necessarily, but they are no longer doing loans for investment purposes, and they've also pulled out of the self-managed super fund market as well, and lending for property within self-managed super fund. And if you know AMP, the group is a wealth management group which specialises in self-managed super funds, and really they've pulled a pin on a pretty important part of their business. So that's the kind of reaction that we've seen at the top end from banks to the regulators' concerns. Obviously, they were very overweight in that market segment, so they've had to pull right back. They've indicated that might change later in the year, but they're not putting any particular time frame on when that's going to turn around. I suspect that's based on what changes happen to their portfolio in the next 6 months. So the other couple of things that are happening, there's been higher rates for investors pretty much across the board. So existing variable loans have had anywhere between 25 and 30 points added to them, so 0.25 to 0.3%. Most of the major banks have changed by about the same amount. They've gone up by 0.27, 0.25, 0.28. It's all about the same what they've done. There's also been some higher rates for interest-only loans, and this particularly applies to NAB and homesite or NAB broker loans. They've applied an extra penalty of 29 basis points on interest-only loans. So if you've got an investment loan with NAB or one of their subsidiaries or associated companies, they've added that almost 0.3 onto the loan just for the fact that it's interest only, and that applies to both investors and homeowners. So if you've got a home loan with NAB or one of their affiliates, which is interest only, you might need to be looking about where that's set. Really, it's nasty. It's just gouging, but there's no real relevance around the interest only loans and providing an extra penalty against them. But that's what they've done. Are there any questions about those things at this stage?
No, mate, no questions coming in just a couple of comments here, basically saying 2 loans with AMP, brilliant to deal with. It's a shame they've taken this line, and all of theirs went up by 27 basis points.
Yeah, that's right. Yes, and they have been brilliant to deal with. And hopefully they'll continue in the other space, in the homeowner space. There's still some good policy, and I'll get to some of that stuff in a minute as well. The other thing that's of interest is that the equity release on investor property has diminished. So where you went to a bank and you had a substantial amount of equity in an investment property, not so much owner occupied, they would used to happily release up to 80% of the value of the property to you as, say, as a line of credit or whatever, whether that be for future property investment or for other alternative investments or shares or whatever. However, this is most of the majors and some of the second tier lenders have limited that on investment properties to a percentage of the value of the loan or the value of the property. So you might be looking at being able to get out $50,000 or $60,000 as a maximum as an equity release. So they're actually ensuring that they're holding more of the equity of the borrowers in investment properties. So they're providing themselves with an extra safety buffer. And if you know my view on risk management, I know that banks are in the business of risk management, but they're in the business of managing their own risk, nothing to do with yours. So I mentioned before about self-managed super funds, and AMP have pulled out of that. Some others have pulled out of that as well. And others have just reduced the LVRs that they'll deal with. I think their objective is to simply keep the regulator at bay. And I guess in some ways we've returned to the bad old days where pricing for mortgage loans was based on purpose, not security. So a house is a house is a house, and the security pretty much is the same, and the pricing behaves in a similar manner, no matter whether it's a home or it's an investment property. But they're now discriminating against investors. So that's thus the title of the webinar, that is a not so brave new world, because we're kind of returning back to where things were 15, 20 years ago. Thankfully, the increase is only I say like 0.3 or 0.4. It used to be a 4 percentage point difference between home and investment loans. So I guess that puts a bit of perspective in it, I suppose. One day I'm going to get these transitions right in these slides. Let's go. There we go. Bastard banks. They've done a few things, and we've talked about some of those already, but they're moving the goalposts for investors. They're changing the ability to borrow. They're changing the ability to leverage existing assets, and they're reducing your ability to acquire more assets. So it's certainly in terms of property assets. The other thing that they're doing is profit gouging, and that's what I call it anyway. When they're increasing the cost of investment loans, where the security is no different from a home loan. And really the increase in interest-only loans by a couple of organisations is just outrageous. It is simply profit gouging. So my view is that yes, that there's a profitability aspect of it. They're also trying to change behaviour and move away from investment and interest-only lending. But what it also does is it helps fund some of the capital raisings to strengthen their balance sheets. We mentioned before the capital raisings that some of the banks are going through. So increasing the profitability prior to that means that the dividends that they need to pay or the cost of raising that extra equity is partially covered by the fact that they've increased their margins on some loans. That's the cynic in me arising, and I think that there might be some truth to that. Self-managed super funds are possibly the next sector to get smashed. There have been some changes, I'm a little concerned that there might be some more that are going to largely take self-managed super fund lending for mums and dads off the table. But we'll see how that develops over the next little while. I think there's an opportunity still to do something now, but I just have this gut feeling that things might change in the next year or so. But it might not necessarily be credit reasons for which they change. Mark, would you have any comment on that?
Yeah, look, it's definitely a concern, mate.
Apparently not.
No, it's yeah. Look, I think it's a concern myself, mate. I'm really I've got a couple of clients that are about to settle in a few months, and there could be some issues to where they actually may not be able to settle. So it'll be the reason why you choose the certain group that I do is because they said to us that they've never forced a client to settle. And we might be testing out that theory in about 8 weeks' time.
Right. Okay. Yeah, things are going to get interesting.
It is, mate. It is.
Things are going to get interesting. But anyway, so for those clients that are already set in self-managed super fund lending, congratulations, well played. However, they've also moved the interest rates up on some of those as well. So if you're not fixed, your variable rates are going to be increasing as well in the same way that investment ones for outside super. The other thing that you need to be aware of is that pricing changes and policy changes are not uniform, and they certainly vary from lender to lender. And I guess that's one of the reasons that everyone should use a broker. And of course, I'm going to say that because I'm a broker. Hello, but half the people don't use brokers, only half do. So, but I think the result will be less investor lending. And actually less profitable property portfolios at the time when they should be at their strongest. And that's kind of frustrating because if you've gone through a higher interest rate environment, you should be able to make some hay in the good times when interest rates are low. So the extra profit gouging that seems to be going on at the moment after the reaction from the regulators and the banks is actually putting a bit of a hold on that for the time being. Okay, collateral damage. This is my favourite slide. So there's some blood on the floor. There's going to be a few bodies around as a result of what has happened. There's some unintended consequences. The massive overreaction to what has been a red hot Sydney property market, and I say Sydney, but Melbourne as well. But the regulators seem to be so Sydney centric that it's not funny. But the fallout from a credit perspective will now be nationwide, retarding housing starts in the rest of the country because Sydney prices are peaking makes no sense whatsoever. New Zealand tried a similar approach, and Auckland housing prices are still growing incredibly strongly. I suspect we're going to see the same in Australia, and I think the regulators have got it wrong just because they're so heavily influenced by what happens south of the Hawkesbury. Yes, it's our biggest market, but it's not the only market. Every region has its own economic drivers that influence supply, demand, prices, and vacancy rates. So the decrease in housing starts is going to be driven by the lack of investor credit. That's going to increase the housing gap. So we're already short by a few 100,000 dwellings, and our net population growth, and a lot of that's largely driven by immigration. But a lot of our population growth isn't able to be housed, and we've already got a gap. So this is just going to make it worse. Now, on a supply and demand situation, you'd say, okay, that's going to make rents go up. Well, we'll see about that. But the decreasing jobs growth in construction, which normally leads us out of recession, which I said back up the front, with this sector being so negatively influenced, it's actually going to stop us from moving out of recession as quickly as we might otherwise. There doesn't seem to be any other impact on other sectors of the economy, which are the ones they want to influence. So by decreasing investor lending and influencing new housing starts, they're not actually positively influencing any of the other areas of the economy. So I kind of wonder what the point was, to be truthful. Thankfully, there are still some opportunities, which is always the silver lining and the pot of gold at the end of the rainbow.
Greg,
So particularly for home.
Sorry,
Yeah.
mate, we've just got a couple of crazies on the line. Apparently, someone seems to think you're a great broker, Greg. So, don't know whether they're drunk.
Well, I think you said that earlier on, didn't you? But I don't know about that. I know lots of stuff, though.
Yeah. Stop drinking at lunchtime, Kate. Carry on.
Right, thank you, Kate. Thank you, Kate. Bless you. So the opportunities that are still around is that, particularly for homeowners, obviously there's opportunities in the right places for lots of people, but particularly for homeowners, there's cashbacks of up to $2,000 just for changing lenders at the moment. Some of those lenders you might not want to go to, but there's literally cashbacks of up to $2,000, and they'll put that in your account after settlement. So that's pretty handy. Usually for loans over $250,000 or $300,000. There's very aggressive pricing for home loans because they're trying to change the structure of their book from investor lending to home lending. They're all trying to eat away at each other's books. So there's some really aggressive pricing in the home loan market. In the home loan market. And they'll still do loan to valuation ratios up to 95%. So for new home purchases, or if you're trading up, there's still plenty of opportunities there from owning a home perspective as opposed to an investor. And there are still good opportunities for cash out, which, as I mentioned before, you can take up to, if you had a $500,000 home and you only had $100,000 in debt, there's really $300,000 equity there to take it up to 80% that could be available to you to invest in other things. So a lot of lenders won't allow you to just have access to that because they want to control your assets. But if you know the right ones, that's still available. And AMP, interestingly, is one of them because they will still do that up to 80 or 85% without asking any questions about what you're using it for. So that's the difference between them. They're still maintaining that space as a cash out facilitator for homeowners. So that's good news, because if we have the right home lender on one side, we can have the right investor lender on the other, and I'd really like to keep them both separate if possible, just to stop, if something happens with your investment property, you shouldn't have any risk on your home. So I like to keep those separate as much as possible. So that's where the opportunities are for homeowners. In terms of investors, we've still got 90% loans available. Some are still pricing as before, not the majors, and only second-tier lenders are doing this. The remainder have made no promises, and so there might yet be further changes. But if you're looking at, I'm just going to pull out one of my rate sheets here, and there's still interest-only investor loans at 4.19%, for example, and 4.24%, but they're not Main Street banks. They're one of them's a mortgage manager, and it's funded on the open markets, on the securitized markets, and the other one's Adelaide Bank, and they haven't changed their policy at all around lending for investors yet. They haven't said that they won't, but they're kind of they're keeping mum at the moment. So let's just see what happens there. But of course, those organisations that do have those lower rates and still have decent fixed rates, there's a good opportunity there to stop the opportunity for further bleeding later on, and maybe get something fixed for a few years while this sort of period of flux is happening. So really, really, this just reinforces why 100% of borrowers should use brokers, not the 52% that currently do. So from a super perspective, the SMSF lending is still on the table, but the playing field just continues to change almost from day to day at the moment. We'll see. I think we'll see that stabilise in a little while. The posts keep moving. So what we used to be able to do was we could do a loan to valuation ratio of 80% for pretty much all SMSF loans for residential property. Now there's only a couple of lenders doing that, and under very strict circumstances. The ballpark figure is now 70%. So what that really means is you need to have more cash in your self-managed super fund to be able to buy a property. and also they're requiring extra reserves or buffers over that amount. So if you needed $100,000 to complete a property before, to buy a property before, you might need $140,000 now, and you'd need to have another $30,000, say, as a reserve. So where you might have been able to get away with $110,000, you might need 160 or 170 these days. So they've certainly moved those goalposts, and things have changed quite a bit there. I think what that might mean is that it might prove difficult for some high density and off the plan purchases in the future, because there'll be that uncertainty around what we can actually borrow. Let's see, if you got set for something and it wasn't going to be completed for a year or two, well, who knows what's going to change with policy between now and then. So that's the interesting question. Is there any questions about some of those opportunities that I've just mentioned? If you just put those in the chat box, and then Mark can pipe up and say hi.
Mate, got one here. What about the roles of non-conforming loans?
So there's still a strong market for non-conforming loans. They really have not changed very much. They tend to still lend to a lower LVR, or they'll do a higher LVR at a higher price. So whilst I've said that the lending margins have decreased, so you can do 90% loans and you can do, less loans in self-managed super funds. I guess that sits in the same basket as non-conforming loans, because really almost anything can be done at a price. It's just to know if you're willing to pay that price. But a non-conforming loan the price that you pay depends on the level of impairment. Normally they're around the level of documentation you can provide for a self-employed person, or the issues around credit impairment if someone's got some defaults or unpaid commitments or debts in the past. So those lenders are still on the table. The likes of Liberty and Bluestone, Pepper, they're all going strongly, and I'm actually anticipating that probably in the next 6 to 12 months they might have a higher frequency of use than they might do otherwise. Certainly for some lending categories. But one of those lenders, Liberty, they are actually doing a lot of work in the prime space as well, and they're one of those lenders that are providing some of those good rates still for prime lending. So, yeah, I hope that answers your question. Anything else at the moment?
Mate, that's it. Another one, quick comment here. Thanks, Greg. This is so interesting, valuable education.
You are most welcome. Thank you for joining us. I really appreciate it.
Yes, and yes, it did answer the question.
Good, excellent. Okay, so the next thing about, what's next basically is what's next, not collateral damage. I still can't get this thing right.
Here's another one, dude. How are loans treated if it's a home loan that converts to an investment loan with interest rates and LVRs, loan to value ratios?
Okay, so if it's already been converted and it's classified as an investment loan, it may have an extra interest charge on it. I'm just going to run through a quick strategy that I do, and I think I know who might be asking this question, so this might answer the question. If you leveraged up your home and took extra equity out of it to buy another home, essentially set your existing home as an interest-only loan and turn it into an investment property, but the bank didn't actually know about that, so all they were doing was releasing the equity for future purchases, it might not increase, because as far as they know, it's still a home loan. So yeah, if the bank doesn't know that your home has become an investment property, there'll be no change. If they have, however, and it's actually classified as an investment property, there will be changes to interest rates only on the variable side, and certainly they've changed fixed rates for new lending, but yeah, case by case basis. Let me have a look at that for you later on. So just I'll have my contact details at the end of the session, so you can get in contact and we can have a conversation about that.
Fantastic.
Okay, well cool.
Mate, one more. What is the process for people with excess funds in their self-managed super funds to do private lending for residential purchases?
Sorry, can you say that again?
Yeah, I will. What is the process for people with excess funds in their self-managed super funds to do private lending for residential purchases?
Right, I'm presuming by private lending for residential purposes, you mean lending to someone else so that they can buy an investment property mainly?
Yeah, that's how I'd get it, mate.
That's the way that reads.
Exactly what I'm
saying. Well, Mark, I think that would probably be best answered by you, because it's not a credit issue from my perspective, because it's a use of funds from a self-managed super fund.
Yeah, I knew that would be the case. Look, I personally think that it's something that you've got to be wary of. You've obviously got to have the arm's length scenario, i.e. don't lend it to your brother, mother, father or sister sort of scenario. And just be careful that you've got the right contracts in place. But most importantly, what you've got to look at is there's only one rule that you really have to abide by in a self-managed super fund, and that's the sole purpose test. So providing that you could prove to the accountant, the auditor, the regulators of self-managed super funds that you were lending that money out for the sole purpose test, and the sole purpose test is for to make sure that whatever your investments are doing, it is for the benefit of the members for their retirement. And that is it. That's the only thing you have to be worried about with a self-managed super fund. So as long as you can prove that is something the case, mate, then yeah, you can pretty much do anything you want, if that makes sense.
One of the keys around that would be getting the right legal advice on your documentation too, as well as the advice around the fund. You need some legal advice on documentation. Yeah. Cool. Okay. I'll just move on to this what's next slide, which is our next before last slide. So the question mark is, how long will it last? I think there's a few things that need to happen before things will turn around again. And if we look at what's happened in the New Zealand market as an indicator, it's a smaller market than ours, but it's running pretty similarly. In fact, with a lot of the same participants. They reduced their maximum lending on anything to 80% a couple of years back, and that really hasn't moved in 2 years. They've seen continued growth in their major property market, which is Auckland, Wellington to a lesser extent, but Auckland has continued to grow fairly strongly. So what I think that we're going to need to see before the regulator takes its foot off the brake is that we need to see the heat out of the Sydney market and the Melbourne market, because they're both big markets. We'll see a fall in investor profitability, and we'll see a fall in loan growth. I don't think we'll see loans going backwards, because that would mean that investors are divesting themselves of their interests faster than others are gaining them, and I don't see that as happening. But my crystal ball says 12 to 18 months. It could be 2 years, but I suspect it's probably 12 to 18 months. That gets us across the hump of the Sydney property cycle. Let's see if my crystal ball has a crack in it. I'm not sure. It's a long bow, but yeah, hopefully it's no longer than that, because it does create a distortion in the market. For SMSF, who knows? If any time is the time to use your self-managed super fund to invest, it must be now, as there's too much uncertainty about it moving forward. So we might not see the same leverage conditions again, and some of that will depend on political political ructions around self-managed super funds. There's Mark could probably comment further about this than myself, but there's the industry funds are making a lot of noise about self-managed super funds at the moment because they're losing business. They're controlled by large unionised organisations, and that's reducing their cash flow. And it'll be interesting to see how much political clout they bring to bear over the next couple of years, which may limit the continued emergence of self-managed super. Let's see, shall we? Again, that's another crystal ball. Hopefully they're not both broken. So the other things that we need to think about, that's what the future might look like, but we need to think about planning and managing portfolios now and a strategy for moving forward. There's a lot of changes, so it's difficult just to race off and pick the first one. I would suggest, I'm a cracked record. I think everyone should use a mortgage broker because you've got access to so many different lenders, and who's got time to do all that homework themselves. So if we can help you with how you're planning and managing your portfolio and strategy moving forward, that's what we'd really like to be able to help you with. Obviously, we've got plenty of information at our disposal, and thank you so much for joining us today. But let's move forward with a strategy and a plan to help you continue your investment growth. I guess that's the key to this. So if you need more information, let's just see how we can help you out. Email is info@theinvestorhub.com.au. Just email us for an obligation-free review, and we'll get on the phone and have a chat. We'll make an appointment and see what we can do just to make sure that A, you're either in the best position you can be, or B, if there's anything that needs to change, how we might be able to help you facilitate that, just to secure your financial flexibility, I guess, and as much as we can around, given where banking has changed over the last month or so, as much flexibility as we can around your financial arrangements, and as much growth possibilities as we can going forward. So really, that's about all from me, and that's pretty good. I was hoping it was going to be about 3/4 of an hour. We don't want to take up everyone's lunch hour, or not the whole of it anyway.
Yeah.
So if you've got any more questions, please pop them in the box, and we can have a bit more of a chat here, or email me. Mark, have you got anything else that you want to add, or any other comments and questions that might have come through?
No, mate, there's no more questions coming through. Everyone's just massive positive feedback, Greg. So, look, we really, here at the Wealth Game, mate, we really love that you're part of our community. Community members, guys, this will be up in the membership site in the next 48 hours. So if you need to go revisit it, feel free to. It'll be up in there in the webinar section. Other than that, mate, that's about it, bud. So really, yeah, I couldn't stress whether you're the best way to think about it, guys, is if even if you're thinking about getting into investing, if you're wanting to just have like you said, a no obligation chat about your current portfolio, where it sits in terms of finance strategy, look, just email Greg. Info at one of his team will get back to you and set up a time. And mate, the amount of information in that guy's head is absolutely amazing. So, Greg, thank you so much again. And those of you that have taken your time out of your lunch hour, it just shows that you guys care about your financial future. And we at the Wealth Game are grateful. Cool, man. That's it.
Thanks, guys. Appreciate your time, everyone, and thanks, Mark, for hosting again today. And don't forget to email through, and we'll have a conversation further if we can help you more. But hopefully the input today has been valuable, and that assists you going forward.
Awesome. Thanks, buddy. Bye for now.
Bye for now.